Hello, everyone. Thank you very much for joining us today for the webinar, which is entitled Financial Independence Retire Early, or more commonly coined as FIRE. My name is Nick Sherlambers, and I'm the Managing Director of Alpha Wealth. I'm conscious some people may be listening to this on playback. For those of you listening live, we do encourage any questions during these webinars. They typically run for about 30 minutes or so. And I just want to make sure that everybody is, I suppose, getting something from this. And I'm joined today by two of my colleagues, Clean O'Donoghue, who's Director of our Business Development, and Ruth Murray, who's Head of our Marketing Department, who are going to assist me. And again, if anyone would like to pose any questions throughout the course of the webinar, we have had some over the last couple of weeks. Please do put them into the chat function. So just to sort of kick off, there's quite a bit to cover today, so I'm going to dive straight into it. Most of you may have been on webinars previously, but for those that haven't, Alpha Wealth are a fairly progressive financial services company. We started just shy of 10 years ago. We're actually celebrating our 10th anniversary at the end of April, and anybody who's around Little Island in Cork is more than welcome to join us. Michael McGrath will be doing a sort of a formal presentation at lunchtime on that Friday. We're 10 advisors based in Cork, and also we have a small presence in Dublin, and we provide straightforward financial advice to individuals of all different types and ages. And really the main focus that I want to get on today with you is that basically FIRE talks about helping people to achieve financial independence, which sounds fairly loose, and I'll explain that briefly in a moment. But the big thing I always say to people when I talk to them is that relying on the state pension, particularly which doesn't take effect from age 66, is not really an ideal position for us. The government have taken steps to try and address this. They're introducing, I suppose, a legislative government pension scheme later on this year called auto-enrollment, which I'm going to touch on. But the main focus today from the webinar is really how you can apply FIRE to your own situation and the practical actions that I think we can all do as takeaways from today.
And Nick, is the FIRE approach really realistic for people on average incomes, or is it more suitable for people that are, earning high incomes?
The focus typically for people has been that we think traditionally that only people who are earning a high income can retire early. And then you read these kind of, I suppose, news stories, and anyone who's kind of following social media would see that even people who would be fairly moderate in their income, but have saved over a long period, can accumulate a lot of wealth. That whole analogy of, 1 cent that doubles every day for 30 days will be worth significantly more than having €1 million. And it's that type of approach. As a general rule, when we speak to individuals, we talk about, financial budgeting, and anyone who's been on any webinar before would have heard me speak about the fact that we should all do a financial budget at least once a year, typically where we use 50% of our income for what our needs, paying mortgage, paying for bills, and so on. About 30% then for desires, things that we like to do, holidays, grocery, expenses, going out, and so on. And then 20% we allocate to saving, and the whole principle of save first. FIRE really turns that on its head. It's quite aggressive in its true form. And just to explain that, FIRE came around back in the early 1990s, and there's a book really that kind of started the whole movement. And what it really is around is reaching financial independence as soon as possible. Now, don't be put off by the fact that I've said it's aggressive. I think there's some really good principles, and that's why we decided to do the topic today, because I think we can all benefit from that. But when I talk about financial independence, I'm not necessarily saying retirement. Although generally speaking, that could be the case. It's about being in a position where you don't have to work for financial reasons. I had a call earlier today with a client who could retire, but they chose not to. And that's really kind of what I'm suggesting. And what that typically means is that you're effectively debt free. It's very hard to be financially independent when you have debt, that you've accumulated sufficient funds and allowed for any future expected expenses. For example, you can retire before your children reach an age of independence, as long as you funded successfully for whatever needs they may have, such as third level and beyond. Lastly, that you have an asset base, which for most people would probably be their pensions, but there may be other assets like a property and so on, that provides them the ability to draw down an income of around 5% a year that will sustain their lifestyle. All sounds really fancy. It's actually relatively straightforward, and I'll explain that out for you. And obviously, FIRE is about doing that as soon as you physically can. And don't be put off by any video you hear, or even if you read the book that's illustrated on the screen there. It's really about what can we do to make the most of the position we find ourselves, and obviously get ourselves into the best position where we don't have to rely on the state, and we certainly don't have to work until we're 66. Again, anyone who has any questions, please do feel free to put them into the chat, and we'd like to make sure that we are addressing them. We will take questions towards the end, and if anyone wants to ask any question at all at any stage, please do reach out to us. Myself and David Looney, who's the other senior financial advisor, are more than happy to kind of assist people in whatever way, however trivial. There has been recent press around FIRE. We ourselves have had some articles feature primarily in the Business Post. And if anyone would like access to these, again, please just drop us a DM or a link, and we will reply to you and send you on the links for the articles, and obviously send you out the recording from today, including anyone who would like slides for sure. So just in terms of explaining to you around what it might mean for you. And it's interesting, there's actually variations of FIRE, and it's fascinating if you look more closely into it, that from the traditional form, which I said was quite aggressive, there are variations of it. People talk about lean FIRE, where, as Clina's just asked, even if you're on a moderate income, that you can achieve financial independence. Might take a little bit longer than the proposed kind of 40 to 50 years of age, but it does enable you to kind of focus on getting to that point in the quickest way possible. I refer to this as kind of like a road, and we're looking to get to the end of the road, and it's basically making that road as straight as possible, trying to obviously make sure that we're not going to hit any pits in the road, and indeed not go off track. Then we talk about fat FIRE, which is really about the high income people who are trying to get to that point as soon as they physically can. Coast, where you essentially try and save as much as you can from an early age, and then just kind of drift then in your later years, which is something that maybe I'm kind of started to tend towards. I'm 50 years of age, and I actually created a category, which is the bottom one, which is called semi-FIRE, where I'm working a lot, I'm earning good money, but I'm also spending a lot because I'm trying to enjoy a lifestyle while I feel I can do so, particularly in a family of 4 children, and obviously wanting to enjoy my own situation.
So Nick, I'm gonna jump in with a question that's come in because it relates to this slide. If somebody uses, let's say, the FIRE method to retire early, what are the tax implications if they have a side gig or something going on the side and not full time, but something to obviously keep them busy? So it's kind of referring to that, semi.
Yeah, it's a good question, because it's interesting. There's a lot of talk now about, I suppose, a less traditional model for all of us. It applies to, I suppose, the way we live our lives. It applies to the fact that, some of us are now looking at additional income streams and sources that typically we probably wouldn't have even considered. So the key thing is, really, I say to people, I think it's possible to retire at 60 for all of us. I really do feel strongly about that, if you want to. 50 tends to be the kind of the magic age if people really strive. The reason I say that is because that's the earliest age that most of us can access our pension schemes at. However, if you're looking to try and get to financial independence before 50, you can't use your pension fund. It does require you to build up a fairly significant nest egg, particularly given that you've got a long income, I suppose, requirement for many, many years. Regarding tax implications, obviously, of side hustles, or call them what you will, additional income streams, these are things that I suppose, again, it's probably worth getting a professional opinion on in relation to how do you structure yourself. I set up a limited company just shy of 10 years ago, probably one of the best things that I could have done from a tax perspective. and really just making sure that you're mitigating the tax that you pay. And I'm going to touch on this as we go through. So it probably leads me on to the fact that how do you even begin? What should we do as a takeaway, regardless of whether we even notionally thinking about, fire, or is it just something that we naturally are kind of, I suppose, succumbing to? And again, if you just think about the main basics of financial planning, which is budgeting, work out what you're earning into the household, including your partner's earnings, if relevant, child allowance, any other alternative income streams, such as like, another form of income, and where that money's being spent. And it really focuses on, not spending money unnecessarily, the save first, spend later approach that I said earlier, which is there's no point you trying to save for something and then doing it at the end of, the month when you've been paid on the first of the month. It generally doesn't work very favorably. I'm going to continue to mention about reviewing your situation regularly. I mentioned this road earlier. The fact is that you're going to need to make pit stops and you need to check in and see where you are, because things change. We've all been through a lot of changes over the last few years. If you just take into account, the likes of COVID, rising interest rates, anyone who's been made redundant, anyone who's changed jobs, and there's always reasons to take account of, where you are. For example, I mentioned around, things that take place. In January this year, we all benefited from the budget changes that happened last October. We all earned probably about 70 to 100 euros extra in January, and most of us probably didn't even realize. And I suppose what I'm really saying here is that it's really about taking a more conscious approach and saying, okay, I am better off now. What am I going to do with that money? Am I just going to absorb it, which naturally happens, or am I going to put it to use? With respect to the things, I suppose, and again, trying to draw on how you can use this in your own situation. I talk about compartmentalizing your goals. It's really important to have a plan. There's no point me talking about, retirement or financial independence when you've got other things that you need to do sooner than that age. So, for example, if you want to buy a new car, I'm trying to avoid people taking out debt unnecessarily. The only debt that I really encourage people to take is a mortgage, because it's the lowest form of debt and you can't buy a house without borrowing money from a bank typically. However, trying to avoid those short-term loans, certainly credit cards, is something that I always try and encourage my clients to do. And I work with them, as does David, to ensure that it's mitigated, because unfortunately the cost of interest, which has gone up a lot recently, will supersede typically any other form of saving that you can do.
And Nick, on that, how can somebody with existing kind of financial obligations, like you've mentioned, like a mortgage, like any existing loans, adapt the FIRE principle to their own situation?
Yes, the starting point of FIRE is get it all on a spreadsheet. When we meet clients, we do a very quick synopsis of where they are. We ask you for about 15 pieces of information, very simple things like, tell me the value of your mortgage, tell me what interest rate you're on. If you're on a fixed rate mortgage, when is it expiring? Some people come back to me and say, I don't know, Nick. And I say, well, respectfully, you have to go and find out. It's really important for the purposes of me being able to help you. If you have a credit union loan, how much interest rate is it? If it's on a 6, 7, 8% interest rate, and then it's a case of what I refer to as a snowball, where you focus on the smallest debt and you pay it off aggressively. So if somebody had, say, a credit card bill for £1,000 that they don't clear every month, they had a car loan for 5,000 euros, and they had a mortgage, that analogy would give you that you pay off the credit card first. You focus all your mind to that. Any excess income that you have that you don't spend goes to the credit card. Once that's paid off, you then focus on the credit union loan. Once that's paid off, you might then focus on paying down the mortgage, particularly given the fact that mortgage interest rates have risen. You get the point. We then refer to things like medium-term goals. How can you save for the medium term, which is typically 3 years or more? What objectives do you have? I mentioned earlier that I have 4 children ranging from 18 down to 9. Are you saving for their third level education needs? There are definitely more appropriate accounts for those. Long-term savings is really, typically your pension. I talk about this 66% trick. That's the tax boost for high rate taxpayers. Anyone who earns over 42,000 a year should really be all over their pension scheme. And yet it's still, I suppose surprises me that a lot of people, even if they have a company pension scheme, don't really fully understand it. And all I'd say to you is independently, if you'd like to get advice, please do reach out to us.
And
And
Nick,
obviously,
on the pension side of things, another question has just come in around how many stamps do you need to have paid in order to ensure that you have the entitlement to the state pension?
that's a really good question. So, people think that you have to work for like 30 or 40 years to get the full Irish state pension. The Irish state pension in Ireland is actually very generous. It's one of the few generous things that we get from the Irish government. It currently pays about 14,500 a year. You have to have 520 even, contributions of PRSI, which effectively equates, that's a weekly contribution rate of about 10 years of full contribution. So unlike the UK, where you have to have about 35 years, the Irish pension could be achieved without necessarily working a very long time. Hence why, even if you do retire early, you can rely and obviously expect, a fairly decent pension to kick in, albeit from the age of 66, which is on the slide. And as I stated there, it's worth actually north of 250,000 euros to people. Obviously, if you live for a reasonable number of years thereafter, and if you don't survive, unfortunately, beyond 66, then okay, you're not going to be around to, I suppose, lose out. Really, to cut to the chase, what I'm saying, in order for you to retire, let's say before the normal retirement age, if you can build up, and you could potentially include the 250,000 from the state pension, a pension pot or an asset base. I'm referring to pensions. It doesn't have to be pensions, but for the purposes of today, I'm going to focus on pensions. Let's say 800,000. So if you've got 550,000 euros and the state pension to look forward to, I do feel that that could enable you to not have to work. Why? Well, let's take the 800,000, and to keep the math simple, I'm just going to assume that you can draw a quarter of that tax-free, which is obviously 200,000 euros. And then the remainder, which is about 600,000, again, I could include the state pension in this scenario, would give you an income of about 48,000 a year. And for most people, that would be sufficient. You can dial that up or down. You can ask me a lot more questions, but take it from me as a principle. If you reach 550,000 or more, I think that will enable you to get there. And the key thing I'd always say to people is, do you know, firstly, where you are in your asset base, including pensions from previous employments? And more importantly is, has anybody done a projection for you, which is something we do for everybody that we speak to the age that you would like to think that you could get out comfortably at 55, 60, 62, whatever. And that can include obviously a partner if relevant. A lot of us are dealing with our finances separately. It's interesting. I had a meeting yesterday with a number of people working for a company, and unlike 10 years ago, and I've been a financial advisor for 25 years, it would have been more common for people to have like their finances joint, one bank account between them. And more commonly, and this includes myself, by the way, is that a lot of us are keeping our own accounts. I suppose it gives us a little bit more independence. And that's totally okay. But sometimes it's important as a family, particularly if you've got a joint asset together, like obviously a property. And from a point of view of retirement planning, you can see here that on the screen, it's better to have two pensions worth 800,000 than one worth 1.6 million. Now, again, I won't get into too much detail today, and you might think 1.6 million is a ridiculously high pension sum. There will be some people on this call that have probably reached that figure already. And that's for those that have worked, I suppose, in companies like Lilly and Pepsi, and maybe on a very high income, and obviously have worked there for a large number of years. It's really difficult to actually avoid reaching that figure. The cap, by the way, in terms of the most that you can achieve in a pension fund is 2.15 million, which may be increased later on this year. And if anyone is coming close to that figure, it is important to get some advice and guidance on that. We do think it will be increased to 2.6 million by the summer. So just moving on, let me give you some
Nick, sorry, I'm going to jump in once more before you start moving on. Just on it was the previous slide. You'll probably cover it off here, but the one before, just the 48,000 K per year. What age of retirement is this based on?
Any age, really. So if I turn 50 and if I have a pension pot of 800,000, I can take my 25% tax free and I can draw an income of 48,000 a year, and it will sustain me if I live to 150. Obviously, as well as that, then, as I said, hopefully you may accumulate other assets that can take up some of the slack. You don't need 800,000 in a pension, and I don't want to put people off who won't get near that. It does depend on how much you earn, and it depends on how many years you give yourself. However, I come across people more regularly that have, say, worked in the UK. And if anybody on the call has worked in the UK for 3 years or more since the 1980s, they should reach out to me. I can give you specific advice about how you can buy back UK state pension years. You just need 10. It won't cost you much money at all. And you'll be entitled then to a percentage of the UK pension from the age of 67. It's a really money for jam entitlement, and it's something that financial advisors are charging €3,000 or more for that advice, and we're happy to offer it as part of our consultation, which I'll talk about later on. Let me give you some quick examples, okay, guys? If you're 25 and you don't think it's possible to reach financial independence at 50, if you're able to put £1,000 a month away into a fund that only costs you €600 if you have to fund it yourself, or if your employer pays into it, it will cost you €200. That's really simple, but that is exactly how you can achieve financial independence. Obviously, the main theme here is that you're giving yourself 25 years from a standing start, and obviously paying in a fairly, considerable contribution at a relatively young age will get you to that point. And that's based on fairly conservative assumptions. What if you're 35 years of age? Okay, let's say somebody at 35 has worked in a couple of different companies, may not know how much they've got in their pension, but let's assume that it accumulates to about 100,000. Again, this is a very general, obvious example. And they would need to make up to 55. So I've obviously extended the age by 5 years to that independence age to around 1,100 a month. But again, with the help from the tax man, and if their company pays into the scheme, that's only costing them €360 a month. If they're 45 and they've built up a fund of, say, 200,000, and again, give or take, that would mean that they need to put in a bit more, which will be about $1,350 a month. But again, with the help of the tax man, it could cost them somewhere around $510 a month. And obviously, with the fact that now everybody working for a company by the end of 2024 will have a company paying into a pension for them, it's going to make that journey a little bit easier. What I'm saying to everybody is don't wait and become auto-enrolled. And I may as well just cover that off now. What is auto-enrollment? If you're working for a company and if you're 23 or older and your company doesn't pay into a pension for you, it will have to. The government are going to force them to make a contribution on your behalf. I'm saying to employees, don't be passive. Don't just let it happen. Speak to your company about whether or not they're going to either set up a company pension for you, because they should. And if not, would they allow you to pay into a pension where they will contribute towards? And again, if anyone's in that position, please do reach out to us. We'd like to help you navigate it. It's going to save you a lot of money, and it's going to give you a much better outcome, particularly if you're earning over 42,000 a year. If you haven't already joined your company pension scheme, you should. Certainly don't let yourself be auto-enrolled. Okay, just to move on then, buying a property in your pension fund. You can, if you have a pension from, say, a previous employment, you can use the monies that you've accumulated as long as it gets up to a fairly decent level. And obviously, we're looking at maybe 150,000 or more. You can use the money in that pension fund to buy an apartment, a property, wherever it is in the country, and you can benefit from the fact that it doesn't, any rent you receive from that property, you do not pay income tax on. And if the value of that property goes up, you do not pay capital gains on the growth of it. It's a really
So Nick,
important principle.
you mentioned 150k, let's say, in your pension pot. What if the property is 200,000? Can you borrow the difference to cover? Can you borrow, should I say, to cover the difference in the price?
You used to be able to. I've actually stated it there on the slide towards the bottom, because it's important to understand that as much as you might like the idea of borrowing money, it's really, really difficult to do it in this environment. It might change in the next few years. I don't think now is the right time to do this. And what I'm saying to people is boost your pension, build it up. if you leave the company you're working with, if it's a current company pension or if it's an ex-company pension, get it managed by somebody. When you get up to that critical figure of say 200, 250, then it puts you in the environment to buy somewhere. I personally would wait until the next budget before, the election, I should say, before I would embark on buying a property. I think there's going to be a bit more action to help people, and certainly it might make sense, particularly with the recent interest rate rises. I'm not convinced that now is a great time to buy, but again, it does provide you that opportunity for anyone who is interested in this, and really information's power. Get advice. You don't have to act on it now, but it does put you in a better vein. Be careful of some advisors. Again, I mentioned earlier about some advisors charging extortionate amounts for UK pension advice. There's some advisors that charge extortionate amounts for setting up this type of pension scheme. It shouldn't cost you anything to do that. Let me talk briefly about short, medium, long-term type arrangements. I just want to show you how you can get your money working harder for you. And this is the principle of FIRE. Anyone who's saving into a bank account on a monthly basis, and all of us should be respectfully in that 0 to 3 year category that I class as short term. Why? Because we all have things that we want to pay for. Our holidays this summer, maybe Christmas that we want to go on somewhere with or buy presents for, and so on and so forth. And it's always a good idea, however small it is, put in 20 euros a month if that's all you can afford, but put it into an account that earns interest. We all got so lazy over the last 13 years because the banks weren't giving us any interest. But then when interest rates rose, we can now benefit from much better deposit interest accounts, but you have to go look for them. AIB, Bank of Ireland online will pay you 3% gross. If you've got money in AIB, they won't give you the 3%. If you set up an online account with them and stick 20 euros a month into it, they will pay you 3%. It's really easy to set up. I encourage all of you to do it. If you've got a lump sum, you can get 4% from one of the banks, but it's not an Irish bank. Myself and David have been talking to clients about looking at options within Europe. There are many banks, the likes of Trade Republic, which is on the screen, Raisin. We've got Lightyear, which is Richard Branson's company, Bunk. This account with Trade Republic, I encourage everybody to look into. It takes you to about 3 or 4 minutes to set up. It's like Revolut on speed. Trade Republic will pay you 4% gross interest for up to 50,000, and you pay dirt tax on the interest. It brings it down to about 2.7 net. Anyone who has more than €1 in their bank account, would you not want to get 4% gross interest on it than getting nothing? And the fact is that that money can be passed back and forward by yourself with no drama. And people keep asking me, how safe is Trade Republic? And I keep saying to them, it's safer than the bank the money's sitting in. I can assure you. They're governed under the EU government guarantee scheme, which is a European-wide one, and they're a very, very safe institution. And there are other options out there if anyone wants to look at them. Medium-term savings, 3 years plus. Anyone who has kids saving for third-level education, I encourage all parents, if they can afford to, and the minimum for these accounts is €100 a month, look at alternative options where you can get much higher rates of interest. We're looking at 5-6% plus per annum, where they're accessible. You get the benefit of compound interest, which is one of the key principles of FIRE, by the way. Einstein coined it and said that it was one of the most powerful forces in the universe. He called it the 8th wonder of the world. If you start even at a moderate level and you find that you get this accumulating interest every year, it will grow to a much, much bigger figure. On the screen there is one of the other takeaways from today, the risk reward chart that most of you are probably somewhat familiar with. It's about helping you to understand that if you have the ability to save for a longer period, you should go higher up the scale. It has nothing to do with your risk preference, honestly. Anyone who is saving for their retirement, and if it's 10 years from now, should be up around 5 or 6 on the scale. They should be nowhere near 1 to 2. 1 to 2, by the way, is low risk. 5, 6, and 7 is obviously high risk, high reward, but it can fall in any given year. Would it really bother you if you had 20 years to wait until you're going to actually receive the money? For lump sums, anybody who sit with money in the bank that doesn't need it for 4 to 5 years, and if you're paying tax at the high rate, there is a government scheme. We constantly talk about this. David, my colleague, is doing a webinar on the 18th of April, which will feature, and we will advertise in the next few weeks. So please do keep an eye out for that. We will send everyone who has registered for this the invitation to that webinar, where David's going to talk a little bit more around the government employment investment incentive scheme. But just very briefly, let's just say you had 10,000 euros in the bank. You could invest in one of the 70 or so qualifying companies, get 3,500 back within 12 months if you invest in the money, and after 4 to 5 years, expect to get your money back plus interest of about 30%. One of the companies that David and myself are talking to clients about is called 5 Mile. May sound a bit left field. I'm not going to go into too much detail with you now, but anyone who lives in Cork, I live in Cork myself. I could show you the property. It's an investment in a restaurant where you take ownership of the asset, you take ownership of the trading business. It's run by a very, very successful team called Clistra, who own and manage a number of hotels, restaurants and bars up and down the country, including a number of Radissons, including Little Island, that's behind me here in Little Island, in Cork, the Muckross Park in Kerry. And they're offering an opportunity to benefit from the success of the restaurant, the cafe, the rotisserie, and they're a really good team. I can tell you, I know one or two of the individuals involved, one or two names are on the screen. Connor Sweeney, for anyone who's in Cork, who knows of Middleton, who may have been to Sage. He ran Sage successfully for a number of years. They're a really, really credible company. The restaurant's going to be renamed as the Fork and Wheel. We can send you details of this investment. The minimum investment amount is 5,000 euros. And honestly, if you're paying tax at the high rate, if you're earning over 50,000 a year, this is an opportunity for you to put some of that money that you've earned sitting in the bank into an investment and to get a really decent return from that. I'm just going to sort of try and bring this together, okay, because I appreciate there's a lot of information that I've given you, but just to remind you, FIRE is really about focus. It's about trying to make sacrifices now. That doesn't mean that I don't want you to go on holidays this year. It's about trying to say, well, okay, is there something that I don't need? You know, any one of us that, you know, sets out their financial budgeter, and I talk about this rule of 72, where if you want to buy something, don't buy it immediately. If you don't need to buy it immediately, of course, this is more the discretionary spending. Wait 72 hours, and if you still feel that you absolutely need it, then buy it. And it's just that approach of, you know, we all get pay rises, we all get bonuses, and we just absorb it into our spending. And FIRE is about just saying, well, okay, if I can live off 40,000 and I get paid 45,000, what am I doing with the excess? Saving, okay, it sounds a bit of a throwaway, but like save like a pessimist and invest like an optimist. Make sure your savings is working harder. I've given you a couple of examples of how you can get more from secure accounts. I haven't gone into much detail about investments. A lot of people ask us about investing in ETFs, about, you know, where we should put our money. Should we invest in Bitcoin? Talk to David and myself. Honestly, we have a lot of experience and expertise as independent brokers, and we'd like to help you make sure that you're doing the right things with your money. I've talked about not taking unnecessary debt. I really am anti-debt. I know it's easy for me to sit here and say this. I understand why people borrow money for cars and so on. Our process in Alpha Wealth is to help you mitigate the debt that you have, make sure you pay the absolute minimum interest rates, including your mortgage interest rate. Tax is the biggest expense we go through in our lifetimes. We pay way too much in tax, and a lot of us are kind of unconsciously doing so. Michael McGrath encouraged all of us in the budget last October to go onto the Revenue Online system, the ROS system. You should all set up an account if you haven't already, and look at what you can claim back for. If you've rented over the last 2 years, or if you have a child that's rented, you should be claiming back the 750 euros a year rent allowance. If you worked at home, which you probably did during the COVID years, did you claim your working from home relief? You can claim 30% of any expenses for heating, electricity, and lighting. You'll be mad not to do that. There's hundreds of euros waiting for you to claim. Some people don't like claiming for these things because they think the tax man's going to get them. And I say to them, but the tax man's going to get you regardless. Why don't you get the money that the tax man owes you? And generally, I do a tax return every year because I always find that I overpay tax, even though my tax position should be fairly straightforward. Bringing it all together then is about obviously making sure that you diversify your assets, that you invest in the right risk. If you said to me, Nick, I have a good company pension scheme, I'd say, okay, what are you doing in terms of AVCs? And more importantly, where is that money going? Send me or David the list of the funds that you have chosen, and we'll help you decipher whether they're the best ones for you. We have no bias here. We can help you reduce the cost of your car, house, and health insurance. We don't sell those products, but we broker them for people. I come across people all the time that don't take advantage of online discounts for health insurance. I mentioned earlier about the number of kids I have. I always avail of child discounts where I pay for one child, get the other free. We waste a lot of money unnecessarily. And what I find is that people just automatically renew their policies. They don't realize that they can reduce the cost of their mortgage protection. They think that it's tied in stone. But anyone paying more than 25 euros a month, I challenge you to reach out to us and see how David and myself can save you money. I've thrown up on the screen there some upcoming webinars. Now, David's is featuring on the 18th of April on EIS and tax reduction schemes. The one that I'm doing myself on Thursday, the 28th of March, is about auto enrollment. So anyone who doesn't have a pension scheme, anyone who is self-employed or runs their own business or has employees, it is a must. I'm going to talk a little bit more around how you can mitigate the cost of auto enrollment. We're delighted to have Richard Hogan, who's doing a webinar on the 17th of May with us. And obviously, most of you may have heard of Richard. Really, really fantastic guy. He's going to delve more into the whole kind of wealth and relationships and personal growth and development. It's a complimentary webinar, of course, and please do register for those. My colleague Clean is going to throw up the way that you can register on the link. So just to maybe bring it all to a close, what we offer in Alpha Wealth for anyone who isn't an existing client of ours is a financial consultation. We normally charge 199 euros. We are reducing that as, I suppose, a bit of an advertisement for our 10th anniversary on the 26th of April to 99 euros for anyone who books in to Alpha Wealth. I think one of my colleagues is going to throw in on the chat the discount code to use. It's 50 Alpha. And you can book in on our booking system, book a consultation with David and myself. There's no drama with it. There's no compulsion to take our advice. But what David and myself will do is that we'll give you a good snapshot of where you are currently. We'll help you in terms of navigating the various different things that you've told us that you want to achieve in your life in the short, medium, long term. We'll save you a lot of money on a variety of things that I've touched on today, and we'll make sure that your money's working as hard as you do. So that's typically what I would suggest strongly. But do go onto our website. There's loads of good tools there. The Financial Budgeter, for example, is one of the tools that I've mentioned earlier that you should access. If you have any questions, and if you're not ready to book a financial consultation, just email us. The email address is info@Alpha Wealth. You can get David on D. Looney at Alpha Wealth, myself, Nick at Alpha Wealth, and we'll happily give you some information and advice. It's not about trying to sell a financial consultation. The financial consultation, honestly, it's really inexpensive. We come across brokers that are charging 400-500 euros plus, and they're trying to sell you something. Myself and David are really trying to advise our clients.